Hey everyone, and welcome back to the channel. Today, we're tackling a huge question that I get all the time. How should I actually be investing my money? It can feel overwhelming with all the options out there, but the secret isn't finding one perfect investment. The secret is understanding yourself. Specifically, your risk tolerance. This is the key to building a portfolio that lets you sleep at night while still helping you reach your financial dreams. So, what is risk tolerance? Simply put, it's how much of a roller coaster ride you can emotionally and financially handle with your investments. Are you the type to get anxious with every little dip in the market? Or are you comfortable with bigger swings for the chance of bigger rewards? There's no right or wrong answer, it's completely personal. And a huge factor that influences this is your age. Let's break it down. If you're in your 20s or 30s, you have one massive advantage: time. Decades. In fact, this long time horizon means you can generally afford to take on more risk. Why? Because if the market takes a downturn, you have plenty of years for it to recover and grow. For you, a portfolio might lean more heavily into stocks or growth-focused funds. These can be more volatile in the short term, but historically, they've offered the highest long-term returns. Think of it like planting a forest. You plant the seeds now, and you have a long time to let them grow into mighty trees, even if there are a few bad weather seasons along the way. Now, let's fast forward a bit. Say you're in your 40s or 50s. You're likely more established in your career, and retirement is starting to appear on the horizon. At this stage, you still have a decent amount of time for growth, but you also want to start protecting the wealth you've already built. So, your risk tolerance might shift from high growth to growth and preservation. You might start balancing your portfolio, maybe shifting some assets from aggressive stocks into more stable investments, like bonds or dividend-paying stocks. It's like tending a mature garden. You're still encouraging growth, but you're also focused on protecting your harvest. Finally, if you reapproaching or already in retirement, your 60s and beyond, your primary goal typically shifts from growing your money to making it last. Your income stream now depends on your investments. In this phase, capital preservation is king. You can't afford a major market downturn that could significantly impact your ability to pay your bills. So, your portfolio should be at its most conservative, focusing on reliable, income-generating assets like high-quality bonds and stable, dividend-paying blue-chip stocks. Your risk tolerance is naturally lower because your time horizon is shorter. You need that money to be there for you month after month. But remember, age isn't the only factor. Your personal goals are just as important. Are you saving for a down payment on a house in 5 years? That's a short-term goal, so you'd want a very low-risk strategy. You can't afford to have that money shrink right before you need it. On the other hand, if you're saving for your newborn's college education 18 years from now, you can be much more aggressive, just like someone in their 20s saving for retirement. So, how do you put this all together? Start by being honest with yourself. How would you feel if your portfolio dropped 20%? If that thought makes you want to hide under your desk, you have a lower risk tolerance. If you see it as a buying opportunity, you have a higher one. Align that feeling with your age and your specific financial goals. Investing is a personal journey, not a competition. The best strategy is the one that's tailored to you. Understanding your risk tolerance is the first and most important step to building wealth confidently. I hope this helped clarify how your age and goals shape your investment strategy. If you found this video helpful, do me a favor and hit that like button. Really helps the channel out. And don't forget to subscribe for more content to help you master your money. Thanks for watching, and I'll see you in the next one.